Hello, and welcome to this exciting discussion on journal entries. We will be reviewing what a general ledger is, what journal entries are, and finally, tips for creating adjusting journal entries. So first, let's quickly review what a general ledger is. The general ledger is the main accounting record for an organization, and the general ledger consists of different ledger accounts. Examples of these accounts include assets, liabilities, expenses, revenues, and equity. Let's review some characteristics of those general ledger account types. Assets are what the organization owns. Assets have a normal debit balance, and we will go more in depth into the significance of the normal balance once we dive into the creation of journal entries. Examples of assets are cash and accounts receivable. Liabilities are what the organization owes. Liabilities have a normal credit balance, and examples include accounts payable and notes payable. Expenses are the items that are purchased. Expenses have a normal debit balance and include salaries, supplies, and services. Revenues are the organization's income, and they have a normal credit balance. Examples include property tax revenues and grant revenues. Finally, we have equity. Equity is whatever is left over after you subtract liabilities from assets. Equity is a normal credit balance and includes owner's equity for a regular for-profit organization and fund balance for organizations that use fund accounting. Government entities like cities, counties, and school districts are examples of organizations that use fund accounting. Finally, we get to the subject of journal entries. As we discussed earlier, the accounting record of an organization is stored in the general ledger. But how does the general ledger get updated? That is where journal entries come into play. Journal entries are accounting transactions that are recorded in the general ledger. Journal entries use debits and credits to record those transactions. Very important, with no exceptions, debits must equal credits. Therefore, each journal entry will contain at least two entries, one debit and one credit. This is where the phrase double entry accounting comes from. The minimum number of entries might be two, but a single journal entry can have multiple entries as long as the total debits equal total credits. So if journal entries are used to make changes to the general ledger, it must be stated that all changes to the general ledger require journal entries. This includes the behind-the-scenes entries that are generated by most accounting systems. Examples will include payroll entries and accounts payable entries. These system-generated journal entries are not usually a problem. The journal entries that require the most attention are the adjusting or manually generated journal entries. Adjusting entries are used to fix errors or make changes and adjustments. Let's review how journal entry transactions will affect a general ledger account. Debit journal entry transactions will increase those general ledger accounts with a normal debit balance. Please review the table presented previously to see which accounts have a normal debit and a normal credit balance. Debit journal entry transactions will decrease the balance of a normally credit balance account. Credit journal entry transactions will do the opposite of debit transactions. In other words, the credit journal entry will increase general ledger accounts with a normal credit balance and decrease the accounts with a normal debit balance. Let's review some tips to keep in mind when creating those adjusting journal entries. It's worth repeating that the debits must equal credits. Most accounting systems will check this and not allow an out-of-balance entry to be posted to the general ledger. Start the journal entry with the account you are most familiar with and know what type of normal balance the account has. Cash is king, as the old saying goes, so memorizing that cash is an asset and has a normal debit balance will go a long way in troubleshooting adjusting entries. Starting with cash, and then analyze what needs to happen to cash. Make a debit entry if cash should increase, and make a credit entry if cash should decrease. The other side of the entry will be the opposite of what happens to cash. This slide shows various journal entry examples. Pay attention to the journal entries that affect more than one fund if fund accounting is required. When moving transactions between funds, the journal entries will have a minimum of 4 entries. Why is that? Because cash must be adjusted in both funds, and an offset account will be needed to be entered in both funds. These entries can become quite complicated, so figuring out what happens in one fund with cash, or the account you know what direction the adjustment needs to go, will allow a logical roadmap to be entered. Some final thoughts. Remember, debits must equal credits. Debits and credits in various accounts can be confusing, so with the account you know how to increase or decrease like cash, and the other side will just be the opposite. And finally, remember to retain any backup documentation as to why the adjusting journal entry was made so they can be adjusted in the future. Thank you for listening and following along. Please feel free to contact me with any questions or comments at kenneth.mcgovern@heinfeldmeach.com.